While my video series 75, we had already completed our discussion on shareholders' funds, which includes share capital, reserves and surplus, share warrant, and application money received pending allotment of shares. Now, while this video series 76, let us start our discussion on non-current liabilities. The non-current liabilities include 1. Long-term borrowing, 2. Deferred tax liabilities, 3. Other long-term liabilities, 4. Long-term provisions. As we understand, any liability, the repayment period of which exceeds 12 months is classified as non-current liability. In the balance sheet, if you look at, this is the format of the balance sheet that has been prescribed by the Companies Act 2013. The equity and liability side have first the shareholders fund followed by non-current liabilities. It also has got 4 columns, the first one being the particulars, second one the note, the third one the current year's figures, the fourth one the last year's, that is the previous year reporting figures. Let us now go to the first item, the long-term borrowings. The long-term borrowings can further be classified as company issuing bonds and debentures and raising funds, which are long-term in nature. Second one is the term loan the company avails either from bank or from others. Others could be a financial institution or a non-banking finance company, etc. The third one is the deposits the company collects either from the public or from the distributors, etc. The fourth one, the loans and advances from related parties. We are aware that they raise loans from relatives, friends, or some group companies, group firms, or from the directors, etc. Companies float debentures and bonds in the market to raise long-term funds for business. Let us understand what is meant by a bond, what is meant by a debenture. Bond is an instrument of acknowledgement of debt which the company issues to the subscribers. Traditionally, the government issues bonds, but these days bonds are also being used by semi-government and non-governmental organizations. The terms debentures and bonds are now being used interchangeably. Actually, both are acknowledging the debt. Now, when it comes to debenture, it is a written instrument acknowledging a debt. It contains a contract for repayment of principal after a specified period or at intervals or at the option of the company, and for payment of interest at a fixed rate payable usually either half yearly or yearly on fixed dates. So the debenture holders get the principal after a specified period or in installments or on a specific date as specified by the company. The interest on the debentures are paid either on half-yearly basis or on yearly basis. So the companies float bonds and debentures in the market to raise long-term funds. The Schedule 3 of the Companies Act prescribes certain requirements for debentures and bonds. The first one is bonds and debentures along with the rate of interest and particulars of redemption or conversion as the case may be shall be stated in descending order of maturity or conversion starting from farthest redemption or conversion date as the case may be. So this should be made known to the users of the financial information. The debentures are either redeemed, that it is repaid to the holders, or they are converted into equity shares. So these details need to be mentioned in the financial statement as per the requirement of the Companies Act 2013. Where bonds and debentures are redeemable by installments, the date of maturity for this purpose must be reckoned as the date on which the first installments becomes due. In case the company decides to pay the debenture holders or bond holders in installments, the date on which the first installment becomes due will be reckoned. Now, particulars of any redeemed bonds, debentures, which the company has power to reissue shall also be disclosed. Sometimes the company prefers to reissue the debentures and bonds. In such cases, it should be disclosed in the financial statement. The second item is term loan. Any credit facility which is stipulated to be repaid in fixed installments over a period of not less than 1 year is to be classified as term loan. The term loan can be availed either from the bank or from NBFC or from any other non-banking finance companies. Term loans are usually granted to various types of borrowers for acquiring fixed assets like land and building, plant and machinery, equipment, vehicles, etc. In the case of an industrial undertaking which is engaged in manufacturing a product, term loans are granted to meet the capital expenditure in the form of acquiring land, building, plant and machinery, etc. Industries need term loan for either setting up a new unit or expansion or diversification of an existing unit. When I say expansion, suppose a project is there which has got a capacity to produce 1000 metric ton and they want to increase the capacity to 1500 ton. For the investment to be made in the plant to increase the capacity, they may require term loan. Similarly, a company which is producing some products which would like to expand or diversify its activities, they may have to set up a project for which they may need term loan. For modernization or renovation of the existing industrial undertaking, either for improving the quality of the products manufactured or reducing the cost of production or otherwise improving the efficiency and profitability of the organization. When it comes to modernization or renovation, suppose there is a project which has already run 20 years, the plant might have become outdated, they may have to modernize the plant. There may be a need to change the machinery with new technology machineries to improvise the production capacity and to increase the profitability. For these purposes, an industrial undertaking may require a term loan. The Schedule 3 of the Companies Act 2013 stipulates that the company should disclose the following information on the term loan. First, the borrowing shall further be classified as secured and unsecured. Whether the term loan availed by the company is secured by a security or it is an unsecured one. Second, the nature of the security shall be specified separately in each case. Then what is the type of the security that has been given by the company to the lenders should be clearly specified. Their loans have been granted by directors or others. The aggregate amount of such loans under each head shall be disclosed. In case there is a personal guarantee available, the details of the personal guarantee given for the purpose of availing the term loan need to be disclosed in the financial statement, that is a balance sheet, for the awareness or the benefit of the users. Terms of repayment of term loan and other loans shall be stated. What is the repayment period? What is the amount of installments to be paid need to be mentioned very clearly. The period and amount of continuing default as on the balance sheet date in repayment of loans and interest shall be specified separately in each case. In case the company had defaulted payment of any interest or installment, it should be made known to the users of the financial statements. These are the new changes which have come in the Companies Act 2013. Say for example, here is a term loan availed from a bank. Here is an unsecured loan availed from some source. So the note 3 will clearly mention long-term borrowing secured. Term loan from bank, the amount outstanding is indicated. Similarly, there is an unsecured loan. So it is very clearly mentioned unsecured loan and the amount. Now, term loan from XXX bank is secured by the following securities. Primary security, charge on the immovable fixed assets of the company situated at dash dash dash. Similarly, in case any collateral security is given, second charge on fixed assets of windmill of the company. Then personal guarantee of Sri Kumar Arora. Then term loan is repayable by monthly installments each of 65,000 per month. So such information need to be provided in the notes of the long-term borrowing. The next one is deposits. The deposits could be a trade deposits which have a repayment period exceeding 12 months. So for example, sometimes the companies are selling the product through distributors. They may insist on the distributors keeping a deposit with them, which is called trade deposits. If the repayment period of the trade deposits exceeds 12 months, it should be mentioned. Another one is the company raising deposit from the public. That also is a long-term borrowing. Second one is loans and advances from related parties. As I have already said, from friends and relatives, from directors, other group, subsidiaries, companies, they should be indicated. Now the next item, having understood the long-term borrowing, the next item coming under the non-current liabilities, deferred tax liabilities. But we will understand both the deferred tax liabilities and deferred tax assets together. Deferred tax assets will appear under non-current assets on the asset side. Since it is similar and opposite, let us understand the deferred tax liability as well as the deferred tax assets together. The taxable profits are calculated as per the provisions of income tax laws. The book profits are calculated from the financial statements prepared in accordance with the rules of the Companies Act. There is a difference between the Income Tax Act and also in the Companies Act in determining the profit of a company. This difference in the concept give rise either to a deferred tax liability or a deferred tax assets. Now look at here, two scenarios. Profit status of the enterprise, book profit is higher than taxable profit. So the current effect is the company will be paying less tax, but future effects on taxes will be company will be paying higher tax. This leads to a deferred tax liability. The second scenario is a taxable profit is higher than the book profit, in which case the current effect will be the company will be paying higher tax, and future effect is the company will be paying less tax. This gives rise to a deferred tax assets. The examples of temporary differences could be one, a depreciation. On second one, a provision for bad and doubtful. Let us understand this more through an example. Now, I will tell you an example for a deferred tax liability. A company had a revenue of 1 lakh. It has provided a depreciation of 20,000 as per the Companies Act. The rate of depreciation to be provided varies between the Companies Act and the Income Tax Act. So in this case, the depreciation as per the Companies Act is 20,000. So the profit as per book is 80,000, and assuming that the tax rate is 30%, the company has to pay a tax of 24,000. Now look at the same scenario as per the Income Tax Act. In the Income Tax Act, the revenue is 1 lakh. Depreciation as per the Income Tax Act is 30,000. So the profit as per income tax is 70,000. Tax payable is 30%, 21,000. So due to the temporary timing difference, the entity is now paying a lower tax of 3,000, which is as per the income tax. For the lower tax paid, deferred tax liability of 3,000 is created, because as per the Companies Act, the tax to be paid is 24,000, but company is actually paying only 21,000. So difference of 3,000 is a liability, and that is appearing in the liability side of the balance sheet as a deferred tax liability. Now look at here. We will go into the analysis of balance sheet in subsequent videos. But while analyzing the balance sheet, some banks add back the DTL to general reserve. Some banks exclude DTL from reserves when computing debt equity ratio. Please keep this in mind, because when we will be discussing the balance sheet analysis, the DTL and DTA will again be discussed. Now let us go to an example for deferred tax assets. I am quoting the same example. Say a company which is making a provision for bad debts. See, the revenue is 1 lakh, provision for bad debt is 20,000, and profit as per book is 80,000, tax to be paid is 24,000. But as per the income tax, the provision for bad debt will be taken into account only when it is actually written off. So here, the profit as per book is 80,000. This 20,000 is to be added back to the profit. So the taxable profit is 1 lakh, because the income tax department doesn't take into account the provision made for bad debts. That will be done only when the bad debt is actually written off. So here the tax will be 30,000 rupees. So here what happens, the income tax allows this provision only when the bad debt is actually written off. So due to the temporary timing difference, the entity is now paying an additional tax of 6,000. For the additional tax of 6,000, the deferred tax asset is created. Here again, while analyzing the balance sheet, some banks subtract DTA from general reserve. Some banks treat DTA as an intangible asset. That we will be discussing when we will be discussing the balance sheet analysis. Now, other long-term liabilities. Any other liabilities such as trade payables, etc., where the repayment period exceeds 12 months. Normally, the trade payable is payable within 12 months, in which case it will be treated as current liability. Wherever the trade payable or any other item where the repayment period exceeds 12 months, such items will be included under other term liabilities. Now let us understand the next item, the long-term provisions. First of all, let us understand what is meant by a provision. There are certain expenses or losses which are related to the current accounting period, but the amount of which is not known with certainty because they are not yet incurred. It is necessary to make provision for such items for ascertaining the true net profit. A provision is an amount set aside from the business profits. You are aware a concept called accounting concept called a concept of conservatism. That is, don't hide any profit, provide for all losses. Now the provisions could be a long term, a provisions could be a short term. The long term provisions appear under the non-current liability and short term provisions appear under the current liability. This we will discuss again when we come to the current liability. For the long term provisions are provision for repairs and renewals of machinery, provision for payment of gratuity, the expenses which are likely to occur after a period of 12 months. I am keeping aside a part of the profit to be met after a period of 12 months. Such things are called long-term provisions. For the short-term provisions, provision for taxation, provision for dividend, provision for discount on debtors, they all come under short-term, which happen or which occur within a period of 12 months. So for the present, we are under long-term borrowing, including long-term provisions as a non-current liability. And now look at a balance sheet where equity and liabilities are there, reserves and surplus is there, then comes the non-current liability. We have completed our discussion on long-term borrowing, deferred tax liability, trade deposits, and long-term provisions. In my next video series 77, we shall continue our discussion on the same topic, company's balance sheet, and understand current liabilities. Subscribe to this channel to receive intimation on my new videos. Press the like button and share the information with your friends. Thank you very much.